record again. It means that you are actually betting against the euro. You have the how will I put it? The idea, or you have the belief that the US dollar is going to be stronger than the euro. So currency pairs are divided. We treated this yesterday into major, crosses, and exotics. So let's move ahead from here. Okay, based on quote currency, it can be a little tricky at first to understand currency pair quotes, but it is pretty simple thing once you comprehend. Euro USD at 1.13327. In this example above, the Euro USD quote is 1.13327. Shows you how much 1 euro is worth in US dollar. Just like when you come and you say USD NGN at 510, which means $1 is worth 510 Nigerian naira. That is the same thing that is happening here. So whatever value that is attached to that particular pair, Euro USD, the value is for the euro, the first currency. Just like you say USD against Nigerian naira at 510, which means $1 is 510 naira. So what this means here is that $1 is worth 1.3327 euros. Sorry, 1 euro is worth 1.3327 US dollars. I don't know if that's clear enough. So this shows you how much 1 euro is worth in US dollar. This means that 1 euro is worth 1.3327 US dollar. The base currency is always the first currency that is listed in the pairing. All right, very clear, thanks. Now, if that is clear, we'll move over to the spread. Now, the best way for me to explain spread for you is if you enter a banking hall, you will always see this signpost or this, what will I call it, this billboard or whatever that is in the bank that say, they will list all the currencies they have, US dollar, euro, pounds, and all of them. They will now say, we buy and we sell. The difference between the amount the bank buys that currency and the amount they sell the currency is what we call the spread. Now, when you bring that down to the broker will always give you two quotations for a particular currency pair. The first quotation is the selling price, and the second one is the asking price, which is the buying price. So the same thing that banks do is the same thing that brokers do. This is their profit margin, because if they buy from you very low, they want to sell to another person high. The difference between what they bought from you and what they sold, the profit they made, is what we call the spread. So it is said here, the difference between the sell quotes and buy quotes in pips, and the higher the liquidity of a currency, the lower the spread. So what it means in essence by higher liquidity is if a currency is in high demand, like this is a currency that everybody will, if you keep it now and say you want someone to buy, someone will always buy it. For instance, the US dollar. The spread is always very small. That is why when you come to your MetaTrader 4, I will still show you something you will do so that you'll be seeing the spread. If you activate that, I think it's called, there's advanced view. If you activate the advanced view mode, it will show you the number of pips in value. If it's 1 pip, if it's 2 pip, like I told you yesterday, the broker I use has very small spread. That is what I use. And that is any broker that has very good spread or small spread. If you take your trade immediately, it doesn't take you time for you to get into profit. So the difference between that sell and buy price is also the profit of the broker. So that is why we have that selling price and the buying price, which is called the spread. Then leverage. Yesterday, I talked about leverage. I told you we'll get into that later on. So here we are on leverage. Leverage allows you to invest a small amount while trading larger positions through a loan from your broker. Leverage is presented in form of a multiplier that shows how much larger the open position is against the margin, the actual investment amount when it is open. Now, what this means, all this plenty English, what this means is that leverage allows you to deposit a small amount of money with your broker and have access to a larger amount that you can trade on the Forex market. So that is it about leverage. Now, in the olden days when people had to leave their house and go all the way to the stock exchange or wherever to trade in the Forex market, because the Forex market has been made easy by the advent of the MetaTrader 4, where you can now stay in the comfort of your home and trade the Forex market. In those days, when for you to trade the Forex market, you have to leave your house and go to the broker's office and be watching a very large television and see whether it's going up or down and tell them, okay, place this trade for me. Those days, you will need a lot of money to actually be a player in the Forex market. But since leverage became, from the days that leverage brokers started giving this kind of leverage, you can now put, let me say, for instance, you can deposit $100 with your broker, and your broker will give you access to $1,000 or access to $10,000, depending on the leverage you select. That's yesterday we were opening an account. I told you I prefer 1:500 and below. Some people even use 1:200, 1:100. What 1:100 means is that for every $1 you deposit with your broker, they give you access to $100. For every $10 you deposit, they give you access to $1,000. 1:500 means for every $1 you deposit with them, they give you access to $500. Now, why that might sound interesting, don't forget that the same way they give you that access is the same way you can lose money. So what it means is that if the person that has 1:100 loses $10, you that have 1:500, you will lose $10 times 5. So that is why we always tell people, look for a company or a broker that has a very good leverage. Most times I prefer 1:500. There was a time, the time I started Forex trading, I was using 1:1000. It will give you access to take more trades, but it will also give you access to blow your account very quickly. All right. This was not in our yesterday training, but we were supposed to treat it yesterday. So let's get back to it. Understanding your trading window. Now, once you open your trading account, this was actually a screenshot I took from my MT4 some time ago. They were all active trades that I was taking that time. Now, if you go to your trade MT4 window, you are going to see a lot of things. You're going to see balance, equity, free margin, margin level percentage, margin. What exactly do these mean? So let's get into that. The balance is the amount of money you have when you have no open position at all. And this amount changes based on the wins and losses you have in your active account. Now, if you open a live account with your trader, your broker right now, and you deposit $100, and you do not place any trade on that $100 account, your balance will be showing $100 at that particular time. So once you place trades, it now starts affecting. That is when you now have equity. Equity shows you the balance amount. That's if that your $100 plus whatever trade you have open, when if you are making profits or loss. So what it means is that if you have that $100 you deposited and you took a trade and you are currently in profit, don't forget, for equity, the trade must be open right now. Whenever you see your equity and your balance, they are not the same. It means that you have an active trade running. But if you don't have an active trade running, your equity and your balance must be the same thing. So the equity shows you your balance amount plus profits or losses. If you are up by 3,000, like take a look at this screenshot here. My balance is $106,000. If you take a look at the top left corner, you will see where it is written trade, $3,327.26. That is the total profit I am making from all these open trades. So if you add this total profit of 3,327 to your balance, you are going to have what is in your equity, which is $109,658. So equity is your balance plus or minus your losses. So if you are losing money, your equity will be your balance minus the amount you are losing. If you are in profit, your equity will be your balance plus your profits. This amount moves when trades are open. Equity equals balance plus floating profit or loss. Now, free margin. Every single one of us that opened the MT4 account, yes, the demo account, you will see this in your account. If you go to the trading open trades window, free margin represents the available money you have in your account to trade with and open new positions. Free margin is equal to equity minus margin. Now, your equity is currently 109,000. Your margin here is $5,901. Your equity minus whatever amount you have in your margin gives you your free margin. Equity, free margin, and balance should all be equal when you have no open position. So when you don't have a trade running, your equity, your free margin, and your balance should be the same thing. The only time they differ is when you have an active trade running on your trading account. Margin level percentage. This is the ratio between equity and margin. When your margin level reaches 100%, you may not be able to take new positions and stand a risk of having your losing position closed automatically. So talking about the idea that brokers can close your trade. Now, if you take a look at the margin level percentage you have here, we have 1,858%, which means on this account, I can take more trades and they will be running concurrently with the ones that are running now. And most times, your leverage, the leverage you selected also helps in determining this, because if your leverage is low, there are only very few trades you can take depending on your balance. So this margin level percentage you are looking at right now, if it gets anything below 100%, I can no longer open trade on this account. What it means is that I either need to close some open positions or I wait for them to hit take profit before I open another position. So whatever you do, do not ever let your margin level percentage get below 100%. Some brokers, once your margin level gets below 100%, they will start closing your losing positions, all your trades that are in losses, starting with the biggest loss. So in essence, you will start to incur losses that you do not plan to incur. At the long run, those trades, don't forget that they might end up going into profits, but the broker is not their concern. As far as your margin level percentage is lower than their required margin level percentage, they will start closing out your trades automatically, beginning with the biggest losing positions. Then we have the margin, your down payments needed to get you in the trade. This is non-leveraged money. When we say brokers got no chill, they are in the business to make money. So whatever makes you lose money, one thing most of us will need to know in the Forex market is it does not matter whether you make money or you lose money, your broker will always make money. And that is why we always look out for the best broker before we start trading. Once you open a trade, bam, once you click buy or sell, your broker has made money from you immediately because there's a percentage they charge you. And then whether you lose that trade or you make that trade profit, the broker still gets their money. If you leave your open positions overnight, they are going to charge you for leaving it overnight. The only difference is that some trades, like there are some pairs that if you are buying them, they give you positive charges. There's what it is called. I've forgotten. We'll get to that. So when you hold the trades, there are some trades that if you hold them for long, instead of the brokers taking money from you, they will be giving you money. But they are very few. They are just about maybe 10% of the currency pairs we have. Some currency pairs, whether you are selling or you're buying, the broker will charge you money. That's the way they work. So the margin is your down payment needed to get you in a trade. This is non-leveraged money. In the event of a margin call, the broker closes your biggest loss and also takes the amount in the margin from your account. The more position you open, the higher your margin. So what this means in essence is, let's say all these trades I have here, they are all in losses. And the highest loss is this USD ZAR, which is dollar South African rand, which is $1,719. If my broker margin calls me, which means my margin level percentage gets below 100%, if they want to close, they are going to first close this USD ZAR, so which means I will lose $1,719. They will also deduct this amount on the margin from my account. So what it means is that I'm going to be losing 1,719 and I'll also be losing 5,901 because it's a down payment. It's just like when you keep your house and you use it to borrow loan from the bank. If you don't repay the loan, the bank takes over your house. So this margin percentage is like your collateral. So when you're on a losing trade and they have to margin call you, they will take the money you are losing and equally take the collateral that you kept down, which is the margin. So that is the way the brokers operate. And that is why you need to actually know what you are doing in the Forex market before you go into it. Now, if you go to the laptop version of the Forex, of MT4, you are going to see the same thing you are seeing here. If you see all these arrows, it is highlighting them. We have the balance, we have the equity, we have the margin, free margin, and margin level percentage. Everything here is also available in the laptop MT4. I hope that is clear up to this place. If it's clear, please, can you type 2 on the chat box so that we'll go to calculating pips. Okay, is it just Joe that is clear up to this point? If everything I've said is clear, please, can you give me a 2 on the chat box? Okay, all right. Thank you, Julius. Thank you, Joseph. Well, if you don't answer, I will assume that you understand. So let's move forward. Now, what is a pip and what is a pipette? Pip is actually, for you to take a trade, this is one of the major things you need to master. A pip is actually an acronym or whatever, what do you call it, for price interest points. The unit of measurement used to express the change in value of the market, which means the smallest change in a currency pair. So if they tell you that Naira moved from dollar moved from 510 the Naira moved from 510 per dollar to 520. There is a difference between them. That difference between them is called pip. In most currencies, especially the advanced currencies, the pips is always a very small value. Now, let's take a look at what we have on the screen. In most currency pairs, the pip is usually the 4th number after the decimal place, with the exception of JPY pairs and gold pairs. So almost all the major pairs, apart from JPY and gold, the pip is the 4th number after the decimal place. So this GBP USD up here, 1.35361. So after the decimal place, we have 3, which is 1. We have 5, which is 2. We have 3, which is 3. Then the 4th number there is 6. So that 6 is the pip. So if they tell you that GBP USD moved from 1.3536 to 1.3537, it means that the market made a 1 pip movement. If they tell you that it moved from 1.3536 to 1.3539, it means that the market made a 3 pips movement. I hope that is understandable. So in the case of JPY pairs, we are still going to treat it so that you understand why they are different. They are not calculated like the way these other currencies, the major currencies, are calculated. So some brokers offer prices that are up to 5 figures. Like if you take a look at the screen here, you will see that this figure is actually up to 5, 1.3536. Why very few brokers gives you 4 digits after the decimal place. Some other brokers gives you 5 digits. So the 5th digit after the decimal is called the pipette. While the 4th digit is called pip, the 5th digit is called pipette. So in this case, 1.35361, 6 is the pip, and 1 at the end of it is the pipette. These are known as pipettes, but the pip always remain the 4th. Even if the broker offers you 10 digits after the decimal place, the pip is always the 4th digit after the decimal place for major currencies apart from JPY and gold pairs. So how do you calculate pips? You entered Euro USD at 1.12537 and exited at 1.14181. How many pips was that? Now, the first thing you need to know is that you need to know out of these two numbers, which one is higher. If you take a look at the screen, 1.12, 1.14, which means 1.14 is higher, which means this price went up. So if the current price is higher than the previous price, because they said it went from 1.12, so which means 1.1253 is the previous price, and it is currently at 1.1418. All you need to do is a simple process. Take the two numbers and deduct it from each other. So deduct 1.14181 from 1.2537. You will get minus 0.1644. We always ignore the negative sign. It doesn't matter. So what this means is that, like I said, the pip is the 4th digit. So what this means is that from 1.12537 to 1.14181 is 164 pips. So what you do is, I'm going to give you the simplest form. So let's avoid all these plenty calculations. Once you do this and you get your figure, slide your decimal place to the right, 4 places to the right. So if you slide this to the right, you're going to have 1, 2, 3, 4, which means just take a look at the last solution we have. That's the simplest one to do. So you move the decimal 4 places to the right, we have 164.4 pips. So that is the movement from 1.12537 to 1.14181 is 164 pips. So if I tell you to determine the from 1.12537, that you should determine a 50 pip movement from 1.137 to the upside, what it means is that I need you to add 50 to 1.12537. If you do that, you are going to get 1.303. I don't know if this is clear enough. Is there anyone confused on this? Maybe you can raise your hand and I will unmute you so that you ask your question, because this is the technical part. So you need to get this very well, because if you don't know, okay, it is not. Let me let me use the other slide. I think it's a little bit clearer there. Okay, so I'm going to be using the explanation on yesterday's slide. It is a little bit clearer on that slide. Now, this is the question here. Calculate 50 pips take profit and 20 pips stop loss. Now, one thing you need to know is take profit. We're still coming to that later. Take profit is if you enter a trade and you want to exit at a certain level in profit, it is called take profit. This is where you want to take your profit. But if you enter a trade, there is what we call stop loss. So stop loss is like a safety net in case the trade goes against you so that you will not lose so much money. So if you were to calculate, if you are buying, if you want to buy a particular pair and they say, okay, let's buy Euro USD at 1.1140, which is what you are seeing on the screen now. And they say, put your take profit at 50 pips. If you are buying, your profit is always above your buying price. Your stop loss is always below your buying price. If you are selling, your take profit is below your current selling price, and your stop loss is above. When we get to that, you will understand. So what this means is that all you need to do is 1.14086. All you need to do is add 2 zeros to these 50 pips they said you should add, and then put it below this. So what you are doing is you are doing 0.0050, which is 50 pips. Put it below this 1.14086 and add. If you add it, you are going to get 1.1458. I think I'm correct. Yeah, 1.1458, as you can see on this answer here. That becomes your take profit. So that is a 50 pip movement. Let's break it down. From 1.1408 to 1.1409 is 1 pip. From 1.1408 to 1.1410 is 2 pips. From 1.1408 to 1.411 is 3 pips. So all you are doing is adding the value of how many pips you want to add to the current price you entered at. But if you are selling, you are deducting the number of pips you are asked to use as your take profit. You deduct it. So let's assume this is a selling trade. Instead of adding 50 pip to this 1.14, we will subtract. That is for selling, because when you are selling, you are expecting the price to go below, to go down. So if price goes below 1.14, which means it has to be somewhere between maybe 1.1407, 1.1406, it keeps going down, 05, 04, 03, 01. So that is when you are selling. But when you are buying, it means the price is appreciating. So whatever value you are asked to use as your pips, take profit, you add it to the figure you have as your entry price. I don't know if it is clear yet. Okay, very clear now. Ada, I don't know if it's clear yet because you asked that I should take it again also. So let's go back to the slide we were using. All right, so take a look at this chart. Let's use this chart to analyze the trade. I said that when you are buying, it means the price is appreciating. So if you take a look at here, this first yellow line below is my entry price for a buy. And I expect that I'm going to exit here when the price gets here. So what this means is that, let's say I have currently dollar is 510 and I have 1 million naira. I want to use it to buy dollar. If I buy dollar currently at 510, if dollar goes to 610, what it means is that for every dollar I have made extra $100. So that is what it means by buying when the price is appreciating. When you anticipate a rise in price, you are expected to buy. So for my entry to be here and my exit to be on top, means that I was expecting that this price will go up, which actually happened. So if they say calculate how many people was gained, if you entered, my entry price was 1.12692 and I exited at 1.13019. So what I do is I subtract them from each other. Can anyone do that and tell me what is the value in pips? Don't forget, when you get your figure, you slide your decimal place 4 places to the right. Let's see if someone can get the answer. Then we can move forward. So entry price 1.1269, exit price 1.13019. I'm waiting. Has anybody gotten the answer? Okay. Just a minute, I'm waiting. I hope it's not only Joe that is calculating. It's pretty simple. Just deduct them from each other. You can deduct the first from the last or last from the first. The idea is if you deduct the higher one from the lower one, you will get a negative sign, which will always ignore the negative sign. So let's know how many pips that is before I reveal the answer. 327, that's one answer. Is there anyone with a different answer? 300. Okay. Any other person? About 300. Joe, there is no about in pip calculation. So those who said 327, you are actually close. What you did is that you made a mistake in sliding the digits. So what you are supposed to get is 0.00327. If you slide your decimal places 4 places to the right, you will find out that what you have is 32.7 pips. So it's not 327, it's 32.7. So you are not far from. Just try it again. Deduct both of them. You will get 0.00327. If you move your decimal places 4 places to the right, so which means the 2 zeros, then back to the 3, and after the 2, we have 32.7. So that is clearer now, right? Joe, it matters. The small change matters. Because we can give a trade and we say, let's exit at 50 pip profit, and every one of us do 50 pip, and you will make a mistake and do 55 pip. And the trade will reach 50 pip, and we will all take profits, and the trade will start going the wrong direction. Then you start losing money. So it matters. Even if it's 1 pip, it matters. But if we get to a stage where if you are now a professional in a way, you will now figure out a way you can decide where you place your take profit. You can even decide to use your own take profit. You understand? So it matters a lot. At the beginning, it matters a lot. I'm very happy Ada says she finally gets it. So let's move over to the exceptions I talked about, which is the gold pair and the Japanese yen pair. For the gold, for the Japanese yen, the second digit after the decimal place is the pip. So instead of the 4th digit, we have the second. If you take a look at this is USD JPY here. It says 110.23. In the case of Euro USD, you'll find out that there is only one number before the decimal. But over here, you find out that there are 3 numbers before the decimal. So your pip for Japanese yen pairs is the second digit after the decimal place. So which means that 110.23 to 110.25 is a 2 pip movement, because 3 is the second figure here after the decimal place. 5 is the second figure after the decimal place here. So if you deduct 5 from 3, you're going to get 2 pips. So if this...
I put something shaky. No, don't take it like that.
Leave me alone.
Sorry.
All right, I've muted him. So from if had it been this moved from 110.23 to 110.33, that's a 10 pip movement for the Japanese yen. So that's the exception to the rule. And then in the case of Japanese yen, after calculating and you get your figure, you move your decimal place 2 places to the right. The other pairs, it is the 4th digit after the decimal place, which is why you move your decimal point 4 places to the right. This case, it is 2 digits after the decimal place, which is why you move your decimal point 2 places to the right. So I hope it's understandable so far. Let's see if there is a calculation for us to do here. So this is a sell trade on USD JPY. I entered at 111.044 and exited at 110.529. So let's calculate this and see if we can get how many pips. 111.044 and exited at 110.529. So let's deduct and move the decimal places and see if we can get how many pips movement this was. Okay, I think I have one answer. 51.5, 51.5. Okay. Any other contrary answer? Or do we all agree with the 51.5? Okay, we can't keep waiting. So let's see the answer to that. 51.5. I am very glad we are actually following what's going on. I'm very, very glad. Let me see that division you are asking of, Joe. You divide in the terms of USD, in terms of JPY pairs, you divide by 0.01. But I didn't want to teach these two first one because it might confuse you. You understand? Another way that is simple is you can, when you get this figure here, instead of moving the decimal place to the right, 2 places to the right, you can times it by 100. It will give you the same thing. Then in this case of the normal figure, you can times it by 10,000. If you times it by 10,000, it gives you your normal pips. You understand? So, but I don't know when, when it comes to pip calculation, there will come a time when you don't even need to use all these things to calculate. Like personally, if I look at 2 figures now, I know how many pips different. So with time, you will get to that level where you can look at entry point and exit point and say, this is 50 pips now. This is 20 pips. It gets easier with time. Okay, so let's go back to I needed to do that pip calculation before we go back to what we have for today, because that was supposed to be taken yesterday. All right, so sorry for switching between slides. I preferred this slide because there are a lot more explanation than the other one. So we're talking about leverage. Leverage allows you to invest a small amount of money while trading. I think I've explained this, where you can have access to a larger amount than what you deposited. Unlike before, if you have to trade Forex market, you need to have millions or thousands of dollars before you can take even one single position in the Forex market. So this is an example of what leverage is. Let's say you bought Euro USD and made 7 pips, which is 0.007. This is what you would have made on these various amounts as capital. So what this means is that if you have $1 and you made 0.0007, that is 7 pips, without leverage, you would have made only $0.00078, which is very, very insignificant. Then if you had a $10 account without leverage, you will make 0.0078. Just leave out these figures. Just look at what it takes you to make a significant amount. That is in the olden days when you trade without leverage. If you make 7 pips in the market, you need to have a $10,000 account for you to make a $7 profit. So you see how tedious the trading the Forex market was in those days. And the same 7 pips you will make $78 if you have a $100,000 account on the same 7 pips without leverage. But right now, with leverage, I can make 7 pips in the market and make $70 with a $100 account if I am a high-risk trader. I can make 7 pips and make $7,000 with the right lot size. We are still getting to lot size so that you understand what lot size means. So this is how tedious trading Forex in those days were. And that is why leverage is one of the best things that happened to the Forex market. But don't abuse it, because if you abuse it, it can bite you very hard. So leverage continued. Various brokers offer different types of leverages, ranging from 1:50 to 1:4,000, which means you can increase the potential earning. 1:4,000 means for every $1 you deposit with your broker, they give you access to $4,000. And don't forget that the same way you make profit with that is the same way you can lose money. And that is why we don't advise people using higher leverages, which means you can increase the potential earning of profits between 50 and 4,000 times faster. So 1:50, the profit you make here, you make 4,000 times of, you make about, is it 2,000 times of it or so on this 1:4,000. But note that the potential for loss is also increased by your leverage amount. Example, 1:200 means for every $1 in your account, your broker allows you to have access to up to $200. And this is vice versa for every other leverage offer by broker. Leverage gives you better return on investment, but can really hurt just as bad without proper money management. So from our former illustration, if you deposit $100,000 of your own money and make 7 pips, your return on investment will be 0.07%. While if you deposit $1,000 of your own money and make 7 pips using 1:100 leverage, which allows you to trade up to $100,000, your return on investment would be 7%. So why this man over here is making 0.07%, you are making 7%. So the difference between the profit you make sometimes can be determined by the leverage you use. But you can also be a professional trader and use some, as a matter of fact, most professional traders don't use crazy leverages. Some of them even use as low as 1:100. You understand? So some of them don't use outrageous leverages. So that is that about leverage. Then lot size. Let's talk about lot size. As you may already know, the change in a currency value relative to another is measured in pips, which is a very, very small percentage of a unit of currency's value. To take advantage of this minute change in value, you need to trade large amounts of a particular currency in order to see any significant profit or loss. Different brokers have different methods for calculating pip value. So, to take advantage of this minute change in value, you need to trade large amounts of a particular currency in order to see any significant profit or loss. Different brokers have different methods for calculating pip values relative to lot size, but whatever way they do it, they will be able to tell you what the pip value is for the currency you are trading at that particular time. In other words, they do all the match calculations for you. As the market moves, so with the pip value, depending on one currency you are trading. All these things are plenty English. So let's talk what exactly is lot size. I believe there are different types of lot sizes. We have the nano lot, we have the micro lot, we have the mini lot, and the standard lot. What is the difference? If you use a nano lot, it means that if you make one pip, If the market makes 1 pip movement, either in favor or against you, you make $0.01, which is 1 cent. So nano lot gives you 1 cent per pip. Micro lot, which is 0.01, which is what I always, many brokers don't have nano lots. Since I started trading, I've not seen a broker that has nano lots. So nano accounts are opened on special request. So our major concerns here are the micro lots, the mini lots, and the standard lots. So when you trade on the micro lot, which is 0.01, that is the smallest lot size you can use for any broker. If you trade that, what it means is that for every single pip the market moves, you make 10 cents. So if the market moves 10 pips, you make $1. If the market moves 20 pips, you make $2. That's for micro lots. Then for mini lots, it is $1 per pip. So if you're trading on a mini lot, which is 0.1, if the market makes 1 pip movement, you make $1. If the market makes 10 pip movement, you make $10. If the market makes 20 pip movement, you make $20. And then the one for the big boys, the standard lot, means that for every move, every pip the market moves, you make $10. So if the market moves 10 pips, you make $10 profit or $10 loss, depending on if the market moved in your favor or against you. So those are what determines the amount of profit you make in the market. You and I can take the same trade now and make the same 50 pips, and you will make $5 and I will make $50, depending on the lot size we both used. Because if you use 0.01, and this lot size are determined by the account size you have. If you have anything less than $500, I would advise you to take a look at using 0.01 to 0.02, nothing more than that, depending on your stop loss. But if there's a way you trade and you become a professional, you can use 0.1 on a particular, maybe a $200 account, depending on your stop loss. Because what we always advise is for every trade you take, do not risk more than 1% of your account. So if you have $100 in your account, any trade you are taking, you must ensure that you don't lose more than $1 from that trade. So which makes it harder. And that is why you must always use 0.01 if you have small accounts. Someone who has a big account of maybe $1,000 can afford to use 0.1. Someone who has $10,000 can afford to use 1 standard lot. But don't forget that you need to have the mindset to use these big lots, because when the market makes 10 pips and you're already losing $100, it takes someone who is well grounded in the Forex market to be able to bear that kind of loss. There are people that trade 10 standard lots. 10 standard lots means that for every move the market makes, every pip move it makes, you make $100. So if you make two pips, $200. There are people that trade 1,000, that trade 100 standard. It depends on your account size. But for the sake of this training, I would always advise you, until you know how to navigate the Forex market, stick to 0.01, because that will give you the kind of loss that your heart or your mind can take. In the Forex market, it does not matter what you know. If you like, be the best, they have the best strategy in the world. If you don't have patience, you don't have the mindset of a trader, you can never make good profit in the Forex market. So that is why you need to stick with a lot size that your mindset at that particular time can carry. So this is a graphical representation of the different lot sizes. It just explains the same thing I just talked about. So what are the types of orders we have? I hope I'm not too fast. Are we following thus far? If you're following, type 1 before we move to the next one. Okay. Thank you. Just keep writing the things down. You can even do screenshots as we go so that you can, maybe if you can't write them down now, you can write it later. So let's talk about the types of orders. Order refers to how a trader enters or exits a trade. There are different types of orders that can be placed in the Forex market. You have to know which type of order your broker accepts. Different brokers accept different types of Forex orders. The most common order types are instant execution or market execution orders, stop entry orders, which is buy or sell stop, limit entry orders, which is buy or sell limit. If you go to your MT4, before we close, we'll still do a little bit of practical so that you will see it on your MT4 how this works. So if you open your types of order on your MT4, you are going to see exactly what we have here. You're going to see instant execution, buy limit and sell limit, which is limit entry orders, and then buy stop and sell stop, which is stop entry orders. So these different orders function in different ways, and we are going to be explaining them one after the other. All right. The first one we are going to take is a market order. A market order is an order to buy or sell at the best available price. For example, the bid price of Euro USD is currently at 1.131 and the ask price is at 1.13112. If you want to buy Euro USD at market price, then it will be sold to you at the price of 1.11312. These are all English. Your trading platform will instantly execute a buy order at that exact price once you click buy. What explains this to your understanding is, it is just like going to ShopRite. If you go to ShopRite, you do not price. Whatever price tag that you see on the particular commodity you want to buy, even if it was placed there by mistake, that is what you're going to pay unless you don't want to buy. So if you are using an instant execution or market order, what it means is that you want to enter the market right now at the current price. You want to buy Euro USD Nigerian Naira is currently 510. So you don't want it to go down or go up. You want to buy it right now at 510. That is instant execution. So that is exactly what it can be likened to. Go to the supermarket, take a look at what they have and buy. If you are okay with the price, you buy. If you're not okay, you go home. So keep in mind that depending on the market conditions, there may be a difference between the price you selected and the final price that is executed on your trading platform. There are various things that can determine this. If your network is bad, you can place an instant execution order, and before your network will send it, the price have moved away from where it is now. And what the computer will give you is the price where the market is at that point when your network sends the order. That is what the market gives you. Sometimes also you might want to place a trade and there is a news. News moves markets very fast. Maybe you click sell and news happens and the market moves 10 pips. They will not give you that market, that particular pair at that price you bought. You are going to buy it at the price where the news moved it to before they accepted the order. So that is that about instant or market execution. Then we have the stop entry orders. A stop entry order, there are two types of order, either a buy stop or a sell stop. And a stop entry order is an order placed to buy above the market or sell below the market at a certain price. Stop order is like a race. Like when they say on your marks, you kneel down, get set, go. You are not entered into the race until you cross the starting line. So when you set a stop order, the market is not executed until the price goes past your stop order price. I just hope this is understandable. For example, let's say GBP USD is currently at 1.2917. And you know that this GBP USD is heading upwards. and you believe that the price will continue in that upward direction, but you don't want to buy it now. You need to be sure that this price will actually continue going up, so that it's not when you buy it will start going down. And then you say, okay, when the price gets to 1.2950, you will buy. That is exactly what a stop order means. You have two options here. You can sit in front of your computer and buy and do instant execution when the price reaches this value, which is 1.295. Or you can simply set a stop entry and go about whatever you are doing. And when the market gets to 1.2950, it will automatically take your trade and put you in the trade. So there are two options. If you want to use, if you want the market to move higher before you buy, you can stay all day on your laptop and it does not get there. Or you can set a stop order and it might not even activate today. Sometimes you might set a stop order, it will activate maybe after 2 days. You can't stay in front of your computer for 2 days monitoring the price. So that is why this stop order is very, very important. Do we understand the stop order so far? Before we move over to the other one, which is the limit order. If you understand the stop order, please type yes or 1 or type 2 on the chat box. Okay. Just 2 people. So I want to believe that every other person also understood what I'm saying. All right, let's move ahead. If you don't understand, maybe you can ask question at the end. Then we move over to the limit order. A limit entry order is an order placed. Okay, sorry, I have a chart. 2, okay, you understand. A limit order entry is an order placed to either buy below the market or sell above the market. Don't forget the stop order is placed to buy above the market and sell below the market. But a limit order is placed to buy below the market and sell above the market at a certain price. Limit orders are like boomerangs. You know, when you send the boomerang out, it reaches a particular place, hits. If you can't go further, it starts coming back. That's the way limit orders work. So what this means is that, let me use the Naira for example. You want to buy, or let me use Bitcoin. Maybe most of us might understand that better. Let's say Bitcoin is currently at 30,000. And you expect that Bitcoin is going to go down to 20,000. But you don't want to start selling it now that it's at 30,000 because you are expecting that Bitcoin will go up a little bit to maybe 35,000 before it starts coming down to 20,000. And you want to buy at 35,000, which is higher than 30,000. Or sell, sorry, at 35,000. So what this means is that you are going to go and place a limit entry order at 35,000. Once the market goes all the way from 30,000 and goes up to 35,000, it will automatically pick your sell order and start going down. Sometimes it can even go a little bit above 35 before it starts coming down. So that's what a limit order is like. It's like you are expecting the market to get to a particular point and make a U-turn. While a stop order is like you're expecting the market to continue moving in that direction after picking you up. Now, let me use another simple example. Let's say you are in Lagos and you want to go to Onitsha. You are at you want to enter a bus to Onitsha at what do you call it, Shagamu. You can stay at Shagamu there and wait. When the bus comes from Lagos, it will pick you up at Shagamu and start heading and continue heading in the same direction where it was heading, which is Onitsha. So that is an example of a stop order. But a limit order is, for example, let's say you want to go to Ibadan, and you are currently at Shagamu. You are expecting a bus coming from Ore to get to Shagamu, instead of you waiting for it to get to Lagos and turn back going to Ibadan before you will enter the bus. The bus will take you and go to Lagos and drop Lagos people and turn back and start going to Ibadan. I think that is a better explanation. So while the stop order continues moving in the same direction, the limit order gets to a certain place and makes a U-turn and starts heading in the opposite direction, whether it is a buy or a sell. So I hope that is more understandable. If it's more understandable, please type yes on the chat box. Hello, I need to know that you are all following, because this can be confusing. And if you don't understand it, you might not be able to place these orders when you are trading. So if you actually got the stop order and the limit order, type 3 on the chat box. If you have a question on any of them, you can raise your hand. I will unmute you, ask your question, or you can type your question in the chat box and I will take it. Okay, Ada is raising up her hand. Let me try to unmute her. Okay, Ada, you can ask your question.
Hello.
Yeah.
Good evening, everyone. Okay, so please, I want to understand, when it gets to the opposite direction, what you talked about, what would it be sold at? I mean, like when it gets to that point and starts going the opposite direction. Do you understand? Do you understand what I'm asking? I do. When it gets to that point that you set it for, and then it hit that point and starts going to the opposite direction. What would it be sold at? I mean, like if it keeps decreasing, if the price keeps going down, what would it be sold at? Would it be sold at the price that it was on when the buyer, wanted to buy it or asked to buy for? I don't know. I'm just confused that. Yes, please.
The market is currently at 1 point. Let me see the example that was given here. Let's say you want to sell Euro USD, and the current price of Euro USD is 1.2050, and you want to sell it, but you don't want to sell it until it gets to 1.2070. So what you need to do, you're going to set your limit entry order at 1.2070 and go about doing whatever you're doing for the day. Once the market comes up to 1.2070, it will pick up your order. You will be entered into the trade at 1.2070. Now
that means I will sell at that price.
Yes, it will be sold to you at 1.2070. Now there are two things to this. If the market passes this 1.2070 and starts going to 1.2080, at that point you will be in loss.
Okay.
Your trade is going to be showing you negative. Maybe it gets to 1.2090, you will still be in negative. Then it now decides to turn from 1.2090 and start coming down. If it comes down to 1.2080, your loss is reducing now. As it is coming down, your loss is reducing. Once it goes down and passes 1.2070, you are now in profit.
Okay.
I hope it's understandable now.
Yes.
So you are entered at the price you set that you wanted to get there before it starts selling. That's the price you are entered at.
Okay. All right. Thank you.
You're welcome. All right, so let's move forward. The next thing we have here is stop loss and take profit. So I told you, a stop loss is your account's safety net. If you have ever come across those guys, civil engineering guys, or those people that build large constructions like Julius Berger, you will notice that most times when they are building, there's always a net underneath what they're building. The reason they have that net is in case one of their staffs fall, that net is going to hold the person, or in case one of their dangerous tools they are using fall, it will first land on this net before it lands on the ground so that it will not injure anybody. So a stop loss is like your account's safety net. A stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if the price goes against you. Now, like the example I gave at that while I was talking about limit entry. Let's say you entered Euro USD at that 1.2070. The market continued going up, 1.2080, continued going up, 1.2090. Probably you decided that you want a 30 pip stop loss. So which means you have a stop loss above that 1.2070 at 30 pip, which will be 1.300, sorry, I need to be sure what I'm saying. We have 1.2070, so plus 30, that is going to give you 1.2100. So you have your stop loss set at 1.2100. Once the trade continues going up, it gets to 1.2080, 1.2090, 1.2095. The moment the trade gets to 1.2100, the market is going to take you out in whatever loss you have made. So if you are using 0.01, which means a 30 pip stop loss will give you minus $3. So the market is going to take you out at $3. Even if the market continues going up to 1.3, 1.2110, 220, 230, you are no longer losing money. But if you don't have your stop loss in place, that loss, as the market is going up, your loss will be increasing, and it can get to an extent where it will blow your whole account. You will not have money in your account again. So that is why we have stop loss. Stop loss is there to prevent you from actually losing all your money. And that is why I always, like I said earlier, for every single trade you take, make sure you don't risk more than 1% of your account. So let's assume that you have a $300 account, which means 30 pips will give you $3, which is exactly 1% of your account. So you don't want to lose more than that on any trade. You don't care which trade it is. But if you don't have your stop loss in place, if the market continues going up 20 pips, 200 pips, now you are losing $20, which is more than 10%, almost 10% of your account. If it goes up to 300% above, you are losing 300 pips, which is $30, which is 10% of your account. So always make sure that your stop loss is, there's a way you calculate it. Maybe we'll still talk about that later, where every single trade, you always aim to lose not more than 1% of your account. If you are in a long position, which means you are buying, your stop loss should be under your entry price. But if you are selling, your stop loss should be above your entry price. So if you are selling at 1.2070, 30 pips stop loss will be 30 pips above 1.2070. But if you are buying at 1.2070, 30 pips stop loss will be 30 pips below. Because what you are saying is that, please, I am expecting this price to go up, but please, in case the price starts going down in my direction, against my direction, once it gets to this 30 pips below my entry, please take me out. I don't want to lose more money. So that is the explanation of stop loss. Every single trade you take as a new person in the Forex market, the first thing you should always do is to put your stop loss, because that is your account safety net. A stop loss order remains in effect until the position is liquidated or you cancel the stop loss order. So that is it about stop loss. I believe we are able to understand that. Then we talk about take profits. Take profit is, let's say you want to take a trade, you want to buy Euro USD, and you want to make 10% of your account, which is $300. So 10% of $300 is $30, which means you need to have on a 0.01 lot size, you need to take a 300 pip take profit. Take profit is there to take you out in the market in profit. And now some people might want to ask, why will I want to leave the market when I am in profit? Yes, let me use this as an example. This chart we had here, let me use it as an example so you understand. I think it's on the other slide. Now, sometimes the market can start going in your direction and you will be happy. And it goes, you are in 100 pip profit, 150 pip, 160, 170. If you don't have a take profit, it might get to an extent that the market have reached its peak and it is no longer moving forward. What it will do is that the market might start coming back down. And as it starts coming back down, that money that you have made, you will start losing it one after the other. Maybe you are making $100 profit. You can start losing it 95, 90, 85, 80. And if you don't actually close the trade manually, you can get to an extent where you were making $100, but you are now in $10 loss. So the take profit is always there to ensure that you are exited at a particular amount. You are saying, I am tired. When it gets to this place, I'm okay with the profit I made. Take me out of the trade. Most times, take profit and stop loss are always placed on key support and resistance zones. We will still get support and resistance zones so that you will understand better. Let me see, I have a question. I don't actually have take profit here. Take profit is just the opposite of stop loss, which means the stop loss will take you out in loss, which means you don't want to lose more money. The take profit will take you out in profit, which means you don't want to make more money after this. Most times you find out that when some trades, if you put a very good take profit, once the market hits your take profit, it will start going in the opposite direction. So which means if there was no take profit, you will start losing that money you have made. And it might get to the extent that plus $100 you had as profit might become minus $20. And there is nobody that wants that in the Forex market. So you always set take profit and stop loss to enable you to exit a trade at a good price. So let's go over to the market analysis, types of analysis we have. The Forex market is like a three-legged chair. That three-legged chair, you know that a three-legged chair, if you cut off one of the legs, it cannot stand. A four-legged chair can even manage 3 legs, but a three-legged chair cannot stand on 2 legs if you cut off one. So which means every single one of these analysis is very, very important. You can never do without any of them. But there are some that are more important than the others. There are traders that only trade technical. There are traders that only trade fundamental. And there are traders that are just sentimental traders. Above on all this, personally, I prefer the technical analysis because technical analysis tells you where the market is going before it gets there. It doesn't mean that you are predicting the market because the wrongest thing you can do in the Forex market is to predict. But if you analyze technically, it is going to give you 2 options, either or. So which means if this happens, I do this. If this happens, I do this. That is how technicals work. So let's take them one after the other. There are ways you can analyze and develop ideas to trade the markets. The 3 basic Forex market analysis are technical, fundamental, and sentimental analysis. There has always been a constant debate as to which analysis is better. But to tell you the truth, you need to know all 3. It is like standing on a 3-legged stool. If one of the legs is weak, the stool will break under your weight and you will fall. The same holds true in trading. If your analysis on any of these 3 types of trading is weak and you ignore it, there is a good chance that it will cause you to lose out on your trade. So what exactly are these analyses? Technical analysis is used by traders to study the price movement. They use historical price movements to determine where price could go, which means they use technical analysts use what price have done in the past to determine where price will likely go in the future. Have you ever heard of the old adage, history tends to repeat itself? As a matter of fact, in the Forex market, it always happens. Most times you find out that history repeats itself in the Forex market. So this is basically what technical analysis is all about. If a price level held as key support or resistance in the past, traders will keep an eye out for it and base their trade around that historical price level. Technical analysts look for similar patterns that have formed in the past, and we form trade ideas believing that price will act the same way it did before. Let me see my chart. Okay, I think we are almost done for the day. Yeah, this is the last. So Joe, this is the last thing we are doing for the day. After this is assignment. So technical analysis takes cognizance of what has happened in the past. That is where you hear people talking about head and shoulder pattern, that once the head and shoulder pattern forms, the market is going to sell. Once an inverse head and shoulder forms, the market is going to buy. We are still going to look at these key patterns, because the technical analysis utilizes patterns like head and shoulder, rectangle, pennant, flag, symmetrical triangle, ascending triangle, double bottom, and double top. These are all used to predict where the price would likely go in future. Then, fundamental analysis is a way of looking at the Forex market by analyzing economic, social, and political forces that may affect the supply and demand of an asset. So if you are a fundamental trader, you need to have DSTV close to you, because you need to be, your best friend needs to be, what's the name of this channel again that always talk about stocks? You have to be watching CNN constantly to know when Donald Trump has said one nonsense to the other, or to know when, what's this man, the richest man in the world, Elon Musk has said one thing. If you are conversant with the crypto markets, Bitcoin and co, you will notice that people have been talking that Elon Musk said something and the market moved. That is fundamental analysis. So those people that base their analysis on fundamental basis, what they do is that they look at the economy of a country, they look at what the president of a country is doing. If there is a war in America now, they know that it will affect American economy. So they don't care about technical, whether there is what do you call it, a pattern that is forming. All they know is that there is a news coming. Most of these people trade the news. Using supply and demand as an indicator of where price could be headed is easy. The hard part is analyzing all the factors that affect supply and demand. And there are a lot of factors affecting supply and demand. So what it means is that technical fundamental traders pay attention to factors that affect supply and demand rather than what the price is doing at that particular time. You have to understand the reason of why and how certain events like an increase in unemployment rates affect a country's economy and monetary policy, which ultimately affects the level of demand for its currency. Now, you agree with me that the central bank determines the value of a currency by either increasing the rates of borrow, what do you call it? The interest rates. If the interest rate of a country, of a currency is very low, it will encourage more lending of the money, which in turn increases the demand of that particular currency. So these are all things that the fundamental analysts take care of. They look at what the current country is doing, whether Nigeria, Boko Haram has bombed everywhere, is going to affect Nigerian economy and all that. So that is that about the fundamental. Then the last but not the least is the, I was talking about Bloomberg. So for you to study fundamentals, you need to be close to Bloomberg TV or Bloomberg.com or forexfactory.com or various economic calendars. If you go to Bloomberg, you are always hearing things about the Forex market, about stock market. So that is what most fundamental analysts use. Then we move over to the sentimental analysis. A lot of people feel that price action should theoretically reflect all available market information. Unfortunately for us traders, it isn't that simple. The Forex market do not simply reflect all of the information out there because traders will all just act the same way. Of course, that isn't how things work. Now, sentimental analysis is based on the fact that you have a feeling. It does not matter whether technical says it should go up or Nigeria economy is crashing, which is fundamental. Sentiment is based on the feeling of people. Sentimental analysis is very important. Each trader has his or her own opinion of why the market is acting the way it does. So which means that sentimental analysis is based on your own opinion. What do you feel the market will do? Do you feel negative about dollar, or you feel positive about dollar, or are you neutral about dollar? Each trader's thoughts and opinion, which are expressed through whatever position they take, helps to form the overall sentiment of the market, regardless of what information is out there. What this means, in essence, is that if we have enough people, let's say there are 100 people that are trading now, and out of that 100, 80 of them believe that the market is going to go up and take a buy position, there is always every opportunity or chance that the market will start going up, because the higher the number of people that say, okay, let's buy, which means the demand is becoming high, the market starts going up. So that is that about sentimental analysis. So before we get into the assignment, or why we are copying down the assignment, can we please write down any questions we have, or if you have, you can unmute yourself. I believe the unmute button is there, it is allowed, everybody is allowed to mute. You can ask your question while we are either screenshotting or copying down the assignment against tomorrow. And don't forget, I said tomorrow I'm not going to be taking the training. The Forex billionaire is going to be taking the training. She's actually in a training right now in a Zoom call. That's why she was not able to join us today. Oh, I think she's even here. She's here. Okay. Forex billionaire, are you here? Peace. I'm seeing her on the chat, but I don't know. Maybe she's not actually listening. So you can screenshot the assignments. Don't forget, it is only those who submit this that are going to be given the link for tomorrow. This is something that people pay a lot of money. There is only one major Forex school in the whole world, and that Forex school is in Dubai. And that school pay a tuition as high as $50,000 US. So that is for you to know what this market, what people can actually do to gain this knowledge. You know, we all went to school and came out. There are certain things that school will never teach you. School will teach you the theoretical principles of making money, but they will never teach you the practical principles of making money. So the Forex trading, the Forex trading knowledge is a practical aspect of money making, which you will never get in any school out there. A lot of people pay crazy to attain, to get all this knowledge. And that is why I was not taking it lightly with people who did not submit the assignment. It means they no longer want to be a part of the class. So as that said, can you highlight more on instant execution? Okay, instant execution, like I said earlier, is like you going to ShopRite. You know that when you enter ShopRite, you are not pricing. Unlike the stop order and the limit order, where you say, no, you don't want to buy at the current price. You want it to go up before you buy, or you want it to go down before you sell. In instant execution, it means you are buying the market or selling it at the current price where it is right now, which means you go to a supermarket, whatever price they put on the commodity you want to buy, you pay it without negotiating. So if they give you a biro at 1,000 naira, you know that a biro should be maybe about 50 naira or thereabouts. You don't care because they put it at that price, that this is what we sell. If you have the money, you buy. If you don't have the money, you leave it. So that is what instant execution means. It means you want to be entered into the trade at the current market price without it going up or going down. I hope that was understood better, Ada. And if you've been able to understand that, can you type? Okay, all right. Joe said, what is the difference between MT4 and MT5 platforms? Well, basically, there is no difference between the two platforms. The major difference between MT4 and MT5 is that most brokers have MT4 platforms. Some brokers don't have MT5. As a matter of fact, another difference between them is that most traders prefer to use MT4 because it came out first and it is more user-friendly. But the MT5 platform have more options than the MT4 has. Because if you go to the MT5, you can see things like stop limit order, which is not available in MT4. You can see there are other trade types that you can take that are apart from instant execution, limit order, and stop order. There is also what we call stop limit order in MT5. But most people prefer to use MT4 platform. Anytime you see me using MT5 platform, it means that I want to trade indices. There are some pairs that are called indices that are not on MT4. You will not see them on MT4. Like when you hear someone saying, I'm trading volatility, it means the person is trading in indices, that is index. You understand? Most of those currencies or pairs or whatever they are called, you will not find them on MT4. You can open an MT5 account and still trade the same way you are trading on MT4 platform. There is no serious difference between them apart from these things I mentioned. Any other question? Questions before we call it a day. Have we all been able to copy or screenshot the assignments? If we are okay with the assignment, please just say yes so that I will know. All right, you're welcome, Joe. Peace, Forex Billionaire, please, are you on the call? I can see you here, but I don't know, maybe you are not listening. Okay, maybe she's not listening. So she's going to be taking us on the last part of this training tomorrow. And those of us who would love to take this course further, we also have a group, if you're interested, that we can add you to. It is free of charge. You understand? For now, it's free of charge. There is no, you can learn advanced levels every Sunday. We used to have trainings every Sunday. You can actually join these trainings and learn other advanced parts of Forex trading, because what we are actually treating now is the beginners and the intermediate parts of Forex trading. So once we